The brightly lit booths found in Malaysian shopping malls are the consumer face of a far larger corporate structure. Behind those mall displays is a major financial institution with a market capitalization exceeding 2.7 billion ringgit. This chart from the fiscal year 2026 report shows the scale of that operation. Revenue grew over 12% to hit 2.47 billion ringgit, yielding a net profit of 385.8 million. These earnings equate to 75.57 sen per share, supporting a 5.74% dividend yield. But those historic profits are now being tested. AEON Credit is currently redirecting millions of ringgit into a high-risk venture, building a digital Islamic bank from the ground up. The core of the investment case now rests on a single question: can the cash generated by traditional lending sustain the heavy capital burn of a digital future? The strength of the legacy business is visible in the latest quarterly numbers, where revenue climbed nearly 10% to 631 million ringgit. To protect these margins, the company is moving away from manual approvals, instead deploying AI-driven credit scoring and digital verification tools to vet every applicant. These models target a specific group: middle-class Malaysians who possess a verifiable track record of consistent repayment. This tracks the effectiveness of that strategy. Despite high national interest rates, shown in red, AEON's non-performing loan ratio, the blue line, dropped to 2.57%. Maintaining this low default rate is why analysts project the company can sustain an 11% annual earnings growth rate. In this view, the traditional lending arm is a reliable cash cow, generating the necessary capital to finance the company's broader ambitions. However, those ambitions center on a new Islamic digital bank and the AEON Living Zone, a massive digital ecosystem. This funnel visualizes how quarterly losses of 16 million ringgit at the digital bank accumulated into a 68.3 million ringgit annual loss. Infrastructure, marketing, and IT require constant capital. To keep the bank capitalized, AEON injected an additional 125 million ringgit in January 2026. They are entering a sector in Southeast Asia known for hyper-competition and high failure rates, where digital banks often struggle to reach profitability. If the app fails to capture a loyal user base, these losses will continue to erode the profit margins earned by the traditional lending business. The macro environment adds another layer of complexity, with Malaysia's GDP projected to grow between 4% and 5% this year. Management has specifically highlighted ongoing geopolitical instability in the Middle East as a major threat to global supply chains. These disruptions drive up oil prices and local inflation, reducing the disposable income of the middle-class borrowers AEON depends on. Over the next 2 years, the combination of digital bank losses and rising marketing costs is likely to put pressure on overall corporate margins. Currently, the stock trades at a price-to-earnings ratio of 7.09. Does this low price reflect a bargain, or these impending margin risks? For long-term investors, a 30.75 dividend provides a significant cash buffer while the company navigates this transition. Management's goal is to transition from a mall-based lender into a closed-loop digital ecosystem, where they own the payments, provide the insurance, and manage the banking. This strategy has shifted AEON Credit into a tech finance hybrid phase. Any investment now is a bet on their ability to capture and hold the digital wallets of the Malaysian middle class.